Hello, this is Solomon Davis again. Another part of buying options. I'm gonna switch over to the other account though, just to be on the safe side to show you some guys things. Earlier. We were looking at QQQ and the options there. Now, and those are good options. What make good options? Number one, plenty of choices. Number one, maybe be too many choices. Is one of the things. You want plenty of expiration dates. Once you start getting more advanced at options, the strategies that you can use, where having more dates is a good thing. The other thing that you want to look at is the strikes. You want dollar worth strikes, 50 cents worth strikes. You want the difference between the strikes to be small. It's the other good thing here. The other good thing that you want to be looking for, the width between the bid and the ask on the price of your option. The bid between these bid and ask, as you can see, is 2 cents. So it might even get down to a penny. So again, that means when you buy an option and you want to sell it right away, if you made a mistake, all you're going to lose is a penny. And a penny is just $1. You always got to remember with options, you got to multiply everything by 100. So that's one of the things that you want to make sure that you understand. The other thing is liquidity. You hear them talk about liquidity. All that means is that there's a lot of traders. As you can see, the open interest here is over 1,000 on these weekly things and all. If you actually go to a monthly expiration, you're probably going to see close to over 10,000, over 100,000. I'm looking at these numbers right here, and these numbers over here, 30,000, 40,000. There's a lot of people to trade with. That's one of the things that you want to be looking for. Now, this part of this video, I just want to make sure I pointed out the good things when it comes to when you want to buy options, things that you need to look out for. You need to make sure there's liquidity. You need to make sure there's a small, let me see, like you got that penny spread. You want to make sure that the difference between the strikes is small. Now, those are the good things. You want something that they say implied volatility is really kind of high for that particular thing. I'm going to try to, if I can remember, I'm going to put a link in the description, to show you how to look at implied volatility and all. I won't get into it too much here, but here's the number over here that you want to be looking at. Because again, when it comes to implied volatility, you see that popping up. It's all relevant to what you are trading. So I'm going to show you how to look at that, and I'm going to put a link in the thing to where you can see, what I'm talking about. Now, what we need to do is look at what do you, when it comes to buying options, what you don't want to trade. And some of the things that you need to be careful. Now, it's not that you don't want to really trade them. You can trade whatever you want to trade. If you because like I say, it's going to take time for you to really understand, some things out here just don't work, at all. Like this, here's a good example right here. If you are, number one, remember I said some of the key things. Again, let me get back to some of the key things that you need to realize when buying options. Location, meaning technically location. If you're buying an option, you're buying a call, I'm going to be focusing on the calls here. You need it to be at a place where your expectation, looking at the technicals, you expect it to go up. You expect the price to be at a low price, and you expect it to increase in price. You need to give yourself enough time to be right, and that's where we was looking at the expirations. You don't want to buy something that's going to expire in 8 days, and it takes more than 8 days for it to reach the price that you expect it to go to. You're going to have to be out here, like I said, a general rule of thumb for me to be 90 days or more out. If you don't have something close to 90 days, you may have to be all the way out here at 150 days. You need to take a look and see if is this 64 days okay for you. The thing is, you need to give yourself enough time for that thing to do what you expect it to do. Or if you see it's not doing what you expect it to do, it gets back to where you need to have that trading plan to realize, okay, how much do I really expect to, I'm willing to lose on this trade if it's not doing what I expect it to do. the other thing, and since you got so much time there, you need to be aware of any events. Some events you can be aware of, like earnings, Fed announcements, job stuff that happens every week. So again, you got to be kind of know you can get this type of fluctuation. Any kind of the thing is, be careful when you're trading individual companies. This is an energy company. Energy companies don't have too much crazy news. But if you was trading some pharmaceutical company, GCTK, I think this one don't even have options. Let me think of another pharmaceutical. Is Johnson and Johnson? Nope. That's Let me think of a Pfizer. What is Pfizer? Does it come up here? Pfizer. Pfizer is a pharmaceutical company, I believe. A Pfizer, it can have some new drug announcement and all. You need to be aware of those type of events and stuff when they're coming up and all. So again, that's why it works out if you are give yourself plenty of time, to be right and all. And let's take a look at here at Pfizer and at that other one that I was just looking at and all, and some of the things that you need to watch out for, when it comes to buying individual company options. I'm going to switch back to this one right here, this energy company. One of the things you will see on this particular company out here, again, this is why you got open interest, another rule of thumb. Since I'm seeing open interest, you can see it's real high at certain strikes and not so high at other strikes. If you plan on buying an option, you need to make sure there is some open interest there, because again, you need somebody to trade with other than the market maker or your broker, because again, they're going to always try to take your money, meaning that if you bought it at a higher price, if you listen to any of those other videos that I sent you about options, they talk about extrinsic value and intrinsic value. Any out of the money option is all extrinsic value. That means it's all fluff. Who's making up these prices is your broker and the market makers, and they can make these prices anything they want to, because again, they control the pricing. So that's why you need to be careful whenever you're trading any out of the money options, because it's all what I call fluff money. It's not even real. The way I look at it, the way I look at it, because that keeps me in the mindset, really knowing that if I'm gonna trade this thing, it needs to make a move, and it needs to make a big move now. It's the way when I like trading. If I'm buying an option, if I'm selling it, I don't care. Okay, but since we're talking about buying options and buying call options, that's one of the things I need to see. Like here today, this volume, it's only 1 and 2 people, but it's a few open options. And I was getting back to one of the rule of thumbs when it comes to buying options: never buy more than 10% of the open interest, because you need to be able to get out of your position. When you buy an option, you have rights and all. If you listen to some of those other videos that I gave you, where they talk about rights and obligations. The rights that you have the right to buy the underlying stock at whatever strike you bought your option at. So say you bought you paid $2.95 here for this option. That's $395, but it gives you the right to buy that stock at $36 a share. Say this thing goes up to $46 a share. So now it's up $10. You still can buy that stock at $36 a share, even though now say you did pay almost $3 to get that right, but now it went up $10. So the difference between $10 and $3 is $7. $3 and $10 is $7. You will make $7 on that trade if you decide to actually purchase the stock and then resell the stock out in the market. Or you can look at it as I'm just give you a quick rule of thumb. If it happened quick and we go $10 lower, 36 down to 26, that option should have went up at least around $7 to $8 in price. because you got $10 now from where you purchased it at of intrinsic value. If you don't know what I'm talking about, look at some of those other videos, or it's something that we can talk about later. Because again, there's intrinsic value and extrinsic values when it comes to the price of a couple of pieces when it comes to the price of options. Now, back to the whole bad thing about options is, let's go down here and look at why you don't buy options with not too much time. Say you was trying to buy this option out here. You see, it looks cheap. It's only 5 cents. It's going to expire in 5 days. You expect it to make a move. If it makes that move, great. But if it doesn't make that move and you think, oh, I won't lose any money, I should be able to get out of that option for my 5 cents. But there's nobody over here willing to buy your option. That's what that zero means. Even though you do have open interest here and you had some volume today, but if these people were actually buyers of this option, there's nobody here willing to sell. There's nobody here if you bought it and you need to sell it, there's nobody to sell it to, because on the bid is where people are actually bidding to buy whatever is for sale. And what's for sale is a April 21, 2023, 38 option, but nobody's willing to buy it. No bids. People are willing to sell it. That's what this means, but nobody's willing to buy it. So I hope this is a key thing that a lot of people seem like they just don't get. If there's nobody there willing to buy your product and all, there's people that are willing to sell it to you, and you are willing to buy it. They're happy to sell it to you, but they're not going to buy it back. They only want to sell. Nobody really wants to buy. That's why I'm going back and forth over this. And you got to realize that if it does move and it moves enough, maybe people will show up here to buy this thing. And what they have to be able to buy it for more than this 5 cents that you actually pay for it. You need for it to at least get to, if you get to 10 cents, you doubled your money, which is a good thing. But it has to move. Now let's take a look at the chart. That's why we look at the technical indicators all the time when we're actually really getting ready to purchase an option. This thing, and let's just go with what was working here. We're looking for something just to move $2, maybe $3. Because if it moves $3, it'll be in the money, and that thing you might make 300, 400, 500% on it. But let's take a look at the chart and see if that even looks realistic. So let me maximize the chart here. Let's switch. That probably was on 9 is where I usually keep all that stuff at. And let's go to a daily chart. Well, since we're looking at such a small time frame, let's take a look at here. As you can see, this is something that I've actually traded before, and there's money to be made if you know how to trade this stuff, on these things like this. But I don't want to get into what that was there. So let's take a look at this. We're looking for this thing in the next 8 days, which is by next Friday, to be all the way up here at $38 a share. And we're at $35 a share. We're looking for it to move $3 in 8 days. This is a rule of thumb, what you can actually use to see, can this thing move $3 in 8 days? We got this bottom that it made on the stochastic. It made a bottom the other day on the stochastic. So again, you might be interested in actually buying a call. And it took, we were looking for a $3 move. And this was at, if you got lucky, it was at the end of the day. It was at $33.50, and it's at 35. We'll say $36. It went to $36 today, did it? Yeah, it went above $36. So 33.50. Let me just do this for you guys. Text 33.50, and we're looking for it to go to $38. We need it to go to $38, and that's that's $4.50. So we're looking for a $4.50 move in 8 days. 8 DAYS. So that's what we're looking for. I'm going to say okay. So that's what we're looking for. Is that possible? We're looking for a, we're not looking for that. That's what it did in 8. That's what it did in, let's go with the 30, 33.50 to 38. It went to right here. Let's go with this 36. Let's take $2 off that. Let me edit this. It went to 36. You're gonna see what I'm doing here. Give me $2 off that was $2.50. It did that in 1, 2, 3, 4, 5 days. It actually did that in 5 days. And this is how I go. This is how you can go about kind of giving yourself, setting up a plan, what you kind of expect. And right now we'll say it's trading at, 35.50. It's actually trading a little bit higher than that. And we needed to go to 30. We needed to go really, it's trading at 35.50, and we needed to go to 38.50. Because if it goes 50 cents above our strike, we'll be 50 cents in the money. That means that we will have at least 50 cents of intrinsic value on that particular option that we purchase. So that's one of the things that you want to have. I kind of like when I'm trading options and buying options, I like my strike to actually end up based on my plan and based on what I see. I want my option to be in the money before expiration or before the time that I expect to be in that particular trade. Even though if I'm buying 30 days out, 60 days out, 90 days out, my expected move based on the strike that I'm selecting and my number of days that I expect this thing to move, I want the strike that I purchased to be in the money if I'm buying an out of the money or close to the money strike. That's one of the other things that I look at. So what we kind of move that we're expecting here is a $3 move. We need $3. We need a $3 move in 8 days. So this trade doesn't look that bad just looking at it, but it's something I definitely wouldn't do. But let me throw this on here. Let me go ahead and do this. So I hope you guys can follow me. What I looked at, I'm looking at my technicals now. This is how you build up that trading plan. And first of all, this is too close to purchase that option, but now we can go look at, we buy something further out. And if we actually really want to trade this thing based on what we are seeing happening here with our technicals. And then we're going to look at the options and see, does it really make sense? This is not a trade recommendation. I have to say again, this is for education purposes only. I will not be doing this trade, to let you know that. We can see right here in 1, 2, 3, 4, 5 days. This thing did go from 33.50. I went from the close of this day to the high of this day right here, which is 30. I went with 36. It went actually a little bit higher than that. The difference between those prices is $2.50 in 5 days. So now, if we were purchasing an option with 8 days to expiration, is it realistic for it to move, $3? That's what we need. And based on what our little view of things that could happen, we're speculating. That's the other reason for people actually buying options. It's just speculation and all, and willing to take some risks. Is it real? It can happen, but I don't know if it's going to happen. I think this is one of the ones we did trade and all. So let's go back over here and take a look at these options again. So buying this up. It's gone up to 10 cents already, so somebody else is seeing the same thing. If they're gonna sell it, they want to make sure they collect enough money to cover anything that may go wrong. And plus, there's other things that they can be doing in order to cover themselves. They can actually buy the stock where they have stock to sell, and all, and they where they can have. It's a ton to think that. Don't worry about what they're doing. Just worry about what you are doing. Your plan. What's your plan? Your plan is to purchase this option here at 10 cents, and can it reach this price before that? But this is not, and that's why I'm going over this though. This is not the ideal place to actually purchase this option. That's why I get back to. That's one of the reasons That's one of the things that I'm looking at when I'm purchasing an option. Is do I have anybody to sell to right now? If I have to, if it moves, yes, I probably will have somebody to sell to. But right now, it doesn't look good at all. So that's one of the things you have to be careful of. So just to go ahead and give you the ideal thing to do is just move out a little further in time and do that trade. And if you see it's going to happen, it can happen pretty quick. Move out just a little bit. Move out to here, and maybe you can do the 38 for 60 cents or do the 37 for 90 cents. That's $90 or $60 a contract. And this is kind of okay. It's not, again, one of the things that you look out for. There is open interest here. There is a little volume here. The bid and ask is not like the Qs where it's a penny wide, it's a nickel wide, but that's what this thing looks like. It's trading in nickel increments. So that's normal for this particular option. So that's some of the things that I wanted to point out. The whole zero thing, the difference between the bid and the ask that can actually be out there, and you want that to be narrow. And it also gets back to, even looking at this particular one, it is realistic for it to do what we expect it to do. Let me see if I can let me bring up some company. I'm looking, let's look at something else. Let's look at this company here. TESS. Let's see if they have options. No options. Let's look at another company here. USA. JWEL. No options. Let me make sure these things are optionable. Optionable, shortable. And then see what we come up with. Let's go to another one. Another one of my rules that I have, if the stock price is less than $5 a share, just buy the stock. Don't play with the options at all. That's just one of my rules. If it's less than $5 a share, buy the stock. Don't buy the option. Although there's a lot of things that are under $5 a share that have great options to trade. And once you get better at trading options and using options as a tool to make money, yes, you can do what you want to do. But while learning, you can trade them in a virtual account, and I'll learn to trade. If you're going to trade things under $5, under $10 with options, and I'll definitely practice those particular options, because one of the other things that you're going to see is what I'm going to actually get ready to show you here right now is these deltas. See how these, and the number of strikes. Let me get where I'm showing all strikes. I'll just let you see. I'm showing all strikes. You don't, when you start trading with things under $10 a share, you don't, a lot of times you may not get that many strikes, because again, we'll go look at the technicals on this particular item. I just drove WW International. I don't even know what this is. Whatever that may be. Personal service. Oh, Weight Watchers. It's Weight Watchers. I didn't know it was Weight. That's Weight Watchers. So again, what you want to look at, and as you can see now, again, with kind of on particular companies, you can get where you don't have those dollar with strikes, or those 50-cent whiff strikes. You got $2.50 whiff strikes. The other thing that's going to happen when you start running into stuff like that, you're going to get where you have deltas that are spread far apart. You got a 0.6 delta at the money, which is trading at $7.70. Your at the money strike is your 750 strike. So again, it is a little bit higher than 0.5 because it is trading a little bit higher than that particular strike. You're out of your one strike out of the money, which is $10, $2.50 higher, is now a 0.3 delta, and all, meaning that it's only going to move 34 cents for every dollar move. A small stock moving a dollar is a lot. That's the whole other thing. So again, that's where it gets back to, you have to be expecting some kind of event, some kind of major move, and this thing did make a major move today. It moved over 20% today, which is, again, that's a lot, a dollar. When something moves, when one of these small stocks move a dollar, you get a high percentage, a high return. And on this particular one, as you can see here at this out of the money strike, in the money strikes, look at the open interest, look at the volume that you actually got out here, way out here, 36 days out. You'll notice, and if you go out here now to our 90 days out, look at the open interest, 12,000. So it's Weight Watch. I didn't know it was Weight Watchers. And look at the volume that you're actually seeing way out here on this particular strike. That's good for a small stock, a stock that's under $10 a strike, or $10 a share, So, but one of the things you have to watch out for, this right here, this one is not as bad as I thought it was. It gets 20 cents wide, it gets 10 cents wide compared to the penny wide, 2 cents wide on the QQQ options. So that's the thing that you need to be very, very, very careful of. So I think I covered it. We want to take a quick look at the charts and see on the charts, this thing actually made a pretty good, it's making a pretty good pop, and making a pretty good pop today. It's making a new high. Let's go back, let's go to a daily, let's go to a weekly chart. On a weekly chart, as you can see, this thing had been dropping. Stochastic, you can say, we can look at our stochastic back here and say, yeah, it was down here. It came up a little bit. It was down here. It faked you out the whole while it was under $10. And it finally made a push higher and then came down to a bottom. And now it's actually making a pop. This is on a weekly chart. Let's go to a daily chart. Let's zoom in a little bit. On our daily chart, we could have seen that this thing was dropping. We crossed out 20. This would have been a thing just before earnings. This is an earnings event. That's why I'm saying you need to be aware of events. You could have called it was a possible catch there on earnings. And now you had, after earnings, you got a close of a gap. And all you were doing was waiting for your stochastic. Your stochastic came back above here, which is around $4 a share. You would have had to hold it a while before you almost doubled your money. Again, me under $5 a share, I would have been looking at purchasing the stock itself and not doing the option. But still, you make good. You still make good on your money. Just going back to the technicals, the options still probably made something crazy. Let's take a look at the options. This is going to be it. I want to show you one more thing on the options. The other thing is, remember I had mentioned implied volatility. Look at these implied volatility numbers over here, and see how they are up in the hundreds, compared to QQQ, which is only less than 50, 10, 20. So again, that's why I'm saying it's relevant to the product that you're actually trading. And I'm gonna throw a link in the description about that. So, but let's go back to this I call it WWW. Let's go back to this thing. Say we were looking at it and we was expecting a pop, and at the time it was under $4. We ended up purchasing the option. And let's take a look and see how well that option actually did. I'm going to show you another little trick. If you hung out in here with me, you get this actual little additional thing. If you saw what I just did and all, I am going to maximize this screen here and show you something. I want to take a quick look at the chart in a couple of ways here for you guys. And this is why another reason everybody should know this. This stuff is available to everybody at all. Let's go back to our daily chart. But I'm showing you how money is made out here. Again, if this was something on your watch list, you was watching this thing because you're into a whole weight thing, and you'd have saw the pop on earnings. The thing is, learn not to chase this stuff when this happens. When it makes a gap, end up setting an alert at this point right here to see if it's going to close the gap, especially after earnings. Because after earnings, a high probability of these things coming back down and closing that gap after earnings. This gap over here may not ever be closed. Let me clean up the chart. Let me do that for you guys where you can see what I'm talking about too. I need the load style. Oh, not there. Let's do it here. Let's do it here. Load style. Let's see what this one have on it. This is a good one. And let's go back over here to our daily chart. Let's go back in here. And let's change our pivots to weekly pivots. So right now. Apply. Okay. And now let's go back down. To show you just exactly how to do this. Okay. This on earnings. Earnings, you saw this thing before earnings. You saw this thing diving. On earnings, this was the day, this looked like the day before earnings, you saw this thing popping. You could have took your chance there, bought your stock, or bought your option, the $5 strike. And the thing is, I want to look at this date. This was 3/2. This was March 2nd. I want to get that date. March 2nd, 3/2. Okay, then say you got lucky, you did buy that. I'm saying lucky because again, nobody knows what's going to happen. Although this thing was double bottom, triple bottom, highly likely that this thing will probably pop. And it did. Now you missed out on that. You didn't catch that 100% pop there, and then it came. So your next shot at this thing is when it comes back down here and fills this gap. You want to go right click gap. You want to know when it's below, this price right here. I like going, you can anywhere in this gap area here or there, wherever. It doesn't really matter. As you see, it came down there. I like going to the lower point because again, I'm not afraid of missing out. There's plenty of stuff out there to trade. So once it came back down here, let's say the first time it came here, say you purchased it right away. You said I definitely don't want to miss out the next time. I got to buy this right now, and you purchased it for $4.10 right at the price that you had it set at. And now you got to be able to willing to hold on to this thing, and all. And now the next date here is 3/13. So 3/13. Is when, say you missed the first time, and 3/13 is the next time, and you paid $4.10 for it, and all. And now today, it dropped all the way down here to what, $3 and let's say 80 cents. And the question, it gets to where the question is, how much of a loss are you willing to take if this thing doesn't do what you expect it to do right away? And you're gonna have to realize this is what most traders call slippage. Are you willing to take a 10% loss? This thing never really dropped 10%. Are you willing to take a 20% loss? Are you willing to take a 50% loss? How much of a loss are you willing to take? So now, this was the date that you actually got in, 10/13. And if you bought the stock, you paid $4.10 for it. Now we want to go look at the option chart. It's the other thing that I just brought up for you, and we want to take a look at the option chart and see if you purchased the option, the $5 strike option, because that's what's available, and all you'd have been going for something out of the money. We're gonna take a look at the option. We're gonna be purchasing an option at that time and see what option we would have purchased. And right now, me, based on the way I am, I'm looking at this. This is the supply up here. This thing is not going to go too much higher than this. Today, I'm out of this trade. And all. If I would have got into it, back here at this time. Let's say we purchased it based on because we was expecting it to come here, but our stochastic was telling us it was still dropping. And let's say we waited until our stochastic came down below and didn't come back up until then. So we ended up it was at the same price, $4.10, but we just got a different date. Let's look at 328 also. I'm going to put 328. The price was the same. But we want to look at the option price. I'm gonna use the 410 price at 328. You could have got it lower. You could have said, let's say you want to get it at $4. Say if it went 10% lower, you would buy more. Let's say here at our stochastic was showing us good. You wouldn't have saw it until the next day. You wouldn't have saw it this day. You saw it stochastic still going down. You would have saw stochastic coming back up. Then you would have saw stochastic actually crossing your first line crossing on this day right here. On this day, your stochastic would have still been up, and it went down to look like it went as low as 380. And the question is, would you buy it? It didn't go 10% lower, but would you bought more at $4? So, but that's all of that. Now, that was back in March. You would have been looking at, you still would have been looking at April options, because April, because you wouldn't have brought the current. The thing is, on March 28th, if you waited on March 13th, you could have brought the April option, because again, you don't buy the current month option. You buy the next month option if you want to buy something close and then you're expecting something to happen right away. Or you go out to the 90 days or more option and all. So there's a couple things that you can be looking at. And what I'm going to do, I'm going to Control C. I'm going to go on the chart. So you could, the first time you could have brought the April option. You could have brought this option if you'd have brought on the March 13, because you wouldn't have brought the March option, you would have brought the April option. And let's look at the April options. The April options, you'd have been looking at it was trading at $4.10. Maybe, and since I don't like buying too far out of the money, you would have purchased a $4.50 strike on the 13th. You'd have purchased a $4.50 strike. Okay, now on the 28th, and we can see where that 450 strike is trading at. It's trading at $3.20 right now. It's where you could be able to get out today, and that's today is the day you want to get out of that trade. Out at $3, and we'll say $3.20. $3.20 out. But we need to know where you would have got in at, how much it would have cost you to get in at $4.50 strike. Now, on the next time it came down to your purchase point on $3, and again, it was at $4. We said go with that $4.10. You would have ended up purchasing. I like the thing is, when you're buying options, I prefer to buy the monthly expiration, because again, you're going to have more open interest, more traders here. You would have been looking at this particular one. these would have been the strikes available, you would have had to purchase the $5 strike at that time. Your out price, it was trading. We're gonna just go with say it was trading at $4. Your out price right now would be $3.90. I mean, $2.90. OUT out, $2.90. What we need to see is how much would you have paid for those options back at that time. And that's what I'm going to show you right now. And this is a way of actually studying, back testing, actually just studying and seeing how well trades will work if they actually meet your expectation. So let's go over here now to this chart, this option chart right here. Now, this is let me show you something. This is a $5 strike with that May expiration, May 19th. Let me go back over here. That's what I should. This is May 19th. It's 19th of May. And the other one that we were looking at is the 21st of April, 21 APRL. And all those were out. And all. So let's go back over to the chart. And I'm going to actually, now what I'm going to do, I'm going to try to copy this, Control C. I'm going to try to go over here. Let's do it this way. I'm going to go text. I'm going to actually do this for you guys. Boom, boom, boom. Oh. Right here. So, April, we'd have been getting out the this. Right now, we're looking at the May option, the May 19th, and our out price right now that we've been able to get out of this trade is that price. But the question is, on March 28th, how much would it cost us to get into that trade? And I'm gonna go ahead and click OK. And right here, we can see, I'm going with the max numbers. We could see that we would have got into that trade for less than 50 cents. We can say 40 cents. We would have been able to get into that trade for 40 cents. We didn't know this was going to happen, even on earnings and this is all after earnings and stuff that we're looking at this particular trade. So our end price, we're going to go with the 40 cents on the 28th, which is this date right here. It's this candle right here. The maximum of that candle is 44 cents, and the minimum of that candle is 34 cents. So let's go with the 44 cents. Let me see what it's saying. The high is 43 cents. Say we got in at the high of 43 cents for that particular trade. Now what we want to look at, as you can see, you can already see, if you remember my numbers, you make crazy money. You can make crazy money on options, and this is why it's so attractive to people. Now on the other one, we was able to go, let's go back to the options. No, let's say we had to go with it, because again, at that time, that option, only these strikes may have been available. So let's go with a $5 strike, and let's just change the expiration. So let's go back, because right now it's showing more expirations, but these other expirations may not have been available at the time. So we're gonna let's go with the $5 strike again, and let's take a look at the price of that option at that time. So the top, I changed that. Let's go here, and it was the 21st of April. So I need to change this to 421. I'm changing these numbers right here. 421, and I just hit enter. As you can see, it comes up for the call option, and it's the $5 strike I said would have been available. And like I said, we would have been getting out at $2.90, but we want to see on, okay, I did this a little bit wrong. We'll look at this again. On this one right here, yeah. It's right. The April one, $5 strike. I was thinking I was looking at. I think we was going to get a different strike. I'll go back to the chart and change it up. Go ahead. We did a $5 strike. Escape. Control C. So I'm looking at April, and I'm looking at on the 13th right here on this date right here. Again, we would have paid the high of that candle. I'm looking up here in this area here. The high of that candle on the 13th. This is the earnings. So this was the earnings pop. If you got in before earnings and caught the earnings pop, you would have did great. But you missed that. So you waited until after earnings. After earnings, it came all the way back down. That's why, again, on options, when you see your profit, you take your profit. Even with this popping right here, right now, it's kind of best to take your profit. Even as you can see, a couple of days ago, this thing was only trading at a nickel. And now it's at $3. This is the whole excitement of options and trading options and all. But back here, as you can see, we said we want to go to the 13th after earnings and all. The price of this thing, the high is 42 cents. I'm gonna put 42 cents. And let me do this. And 328, 3/28, and N. And then N, we're saying what we said on the 13th, the high. If you got in at the high, which is 42 cents, it's actually $42 now. You got to remember that. 42 on 3/13. And that's it. Let me copy and paste, and then we'll go over this. Let me go back to the chart. What did I put that at? Oh, I put it on the option chart, didn't I? Let's put it here. Control V. I end up finding a crazy trade. Let's activate. And let's move this over like this. So now, this is a good example of looking at, things that normally you have to be careful when you're actually trading them. But if you're the risky type person and you get all the setups, it can pay off big. On this first one, on the 13th, first of all, it came about, this trade came about because you missed out on earnings. Earnings pop, it pulled back down, you look to get in and all after earnings. And one of your rules is if it comes back down and close the gap, I want to be in the trade. The other rule that you have in place, again, it gets all back to having a plan and having a set of rules that you trade by. If the stochastic comes back down to the bottom and crosses back over, I want to be in that trade. These are the dates that it actually came back down to those points. These are the prices that you could have actually purchased the stock, and these are the prices that you actually could have purchased the option. On the stock, you got a $3 move with 100 shares. That's $300 that you would have made in both cases. I'll just go with the $4. I'll go with the $4 a share in both cases. But with the option, say you spent you purchased say you spent that same, say you were willing to spend half that money. It would have cost you $400 to buy 100 shares. So you say, if this thing doesn't work, I don't want to. If it ends up going to half that, I'm willing to lose 50% of that, $200. I hope that's not a lot of money. That can be a lot of money in some cases. So you're willing to only this costs you $40. You're only willing to get 5 contracts. Spend about $200 in both cases. But that $200, those 5 contracts now went to $3.20 in one case and $2.90 in the other case. We'll say an average of $3 a contract. And also now those 5 contracts and all now at $3 a contract. What does that equal, guys? I am going to tell you here right quick. You made $3 a contract, which equals $300. 5 contracts. Let's buy 5 contracts. CONTRACTS at approximately $200. It costs you $200 to get into this trade. But you made profit. PROFIT. 5 times that is profit is $1,500. $1,500 minus $200. Your cost, which equals $1,300. And I just really found this just searching out there on Finviz. I wasn't really, again, you realize I don't plan anything out when it comes to these videos. It's so much out here, always. Trades are always available. That's the whole thing, edit. And it's kind of surprising how many people put out bad stuff, bad trades. I would always wonder, are they on the opposite side of that trade? What's going on with that? So sum it all up, when it comes to options, things to look out for is the bid ask too wide, the strikes too wide, no buyers when you try, nobody to sell to when you're buying options. But get back to this one again. If you do have things like this, you're looking not to have something like that out here when you're looking to buy your options. You want bid and ask, bid and ask, bid and ask. And when you're actually purchasing that option, when it does get down to this point, it does something crazy and all. Let's go down here. You do have bid and ask, bid and ask, bid and ask at the strike. Since you purchased a strike where you're expecting it to go through, you're going to have an in the money option. So there's not going to be any problem with open interest or volume. So that's the key. The key still, in my opinion, gets back to understanding the technicals and what can happen and all. My expectation on this thing, since we brought it after earnings, the council, we brought it after earnings on this date here, was at least to go back to this point right here. If it went there on earnings and had good announcement on earnings and a well-known company, a lot of times they do this right here and all. So that would have been my expectation and all. And spending only $200, you got to get where you're comfortable with small, this is small amount compared to you made 5 times your money. And that's what you got to be looking for. So I hope this is helpful, how I kind of went through this whole little example, even though it's an after the fact, something that's happening right now, even though it's kind of after the fact, where would you have gotten in at, what you would have been looking at in order to do this particular trade. You wouldn't have gotten out of this trade, you wouldn't have gotten out of this trade until maybe yesterday. You would have got out of this trade sometime this week. If you would have purchased the stock back here, or if you would have purchased the option back here. And that's why it gets back to the thing, give yourself enough time to be right. Get where you depend on your indicators. Get where you have a target in mind. Where do you expect this thing to go? Understand the product that you are trading. This is a well-known company. This is not some unknown company. I didn't realize that when I first picked it. But it's kind of like when I search, I try not to mess around. I try to look at some other things. Usually when you look at companies that are not well-known, like I did right here, and expecting something to be happening, it's already at the top. It's already made its move, and it's not moving that much. It did get way up here, but they don't have options. Because again, market makers and other guys, they don't want to be dealing with stuff that's going to make crazy move, and they're going to end up losing money. But this right here actually ended up working out for us. So I hope I didn't get too rambling on too much. I hope I gave you some good information. Hope this is helpful. Hope you can see, what's going on here with options, and buying options, can be a good thing, but use these technical, if you're going to be buying a call, use these technicals, use these charts to see what's actually happening. The technicals, and you had an event, you actually had a bullish engulfing here before an event, and you had confirmation of it. That was, I take a chance, $3, $4 a share. And then afterwards, it did come back down and close the gap. It did not go below the low of its earnings and all. So again, I'll take, and your stochastic came back down and came back up. I'll take a chance. That's what you're looking for. Especially when buying options, because the only other thing that you have on your side is direction. You need some kind of event or something to give you that push in order for you to make money. Hope this is helpful. Hope this was good. I know I got kind of long, and I will try to put a link on to kind of give you an understanding of implied volatility. Until Sunday, have a great one. Talk to you later. Bye.